Hello, and welcome to the M&A Science Podcast. This podcast is part of a mission to rethink how M&A is done. The old school, settle-led approach, it's dead. Buyer-led M&A is all about strategy, alignment, and efficiency, putting value creation at the center of every deal. And let's be real, it's not just about closing the deal, it's about making it successful. We uncover what truly works in M&A by learning directly from the best. I'm your host, Kison Patel, founder and CEO at Deal Room and chief scientist at M&A Science. Second part of our interview with Stu Campbell, partner at TCG. Today we're going to talk about how growth equity differs from other investment models. We'll talk about the various investment models. We'll talk about the relationship with the board, working with investors, and how do you get the best terms when it comes to negotiating with investors. This goes back to that right partner. We're going to run twice as far, twice as fast. And I know that from some of these conversations. I know, like we talked about, we threw a couple names out there. Your firm's got a lot of great, strong reputation. So then all of a sudden, you are going to start favoring that relationship because you've established that. There is aspiration, but there's almost confidence that you'll be able to achieve it.
Absolutely. And so we at TCG meet founders all the time, irregardless of when they want to transact. You want to meet great founders of great businesses and then start to help them build. And sometimes the feedback coming out of a first, second, or even third meeting is, I don't think there's a deal here anytime soon. But if there is, we got to be on it, right? And so in getting to know those founders and supporting them, that's the relationship that gives you that opportunity. And so we love it. We embrace it. We find more connectivity and benefit among our network and among founders. And if a transaction happens, that's great. But it's just a beautiful part of the process.
Even though I like you, I still want to give some competition. It's still like, let's
Absolutely.
kind of see so I can compare your term sheet to something else. What are red flags I should look out for? Because sometimes I get this, right? You go dating, all things look good, then boom, you find out some crazy surprise about this person.
Absolutely.
What are those usually for investors?
When you're starting to narrow that list, make some calls, right? And I'd encourage founders to call portfolio companies, right? And
hit up their CEOs and say, hey,
ring up their CEO and say, hey, clearly because you're part of growth equity firm's portfolio company A, they got to you. What's it been like, right? They're calling me. We're starting to get towards more advanced discussions. Give it to me, right? How has it been with them? What's been the most trying time? And then beyond the portfolio companies that are, well put out there on the site, you'll figure out which ones have not gone well, right? And either directly asked the partner for which portfolio companies they've worked on, and then do your own research. If you're in YPO, go start to circulate a few names and see what you can go generate. But doing reverse diligence on the firms is of the utmost importance.
Backdoor references.
Absolutely.
Okay. That makes sense. That's the best way to really get a sense of, and that's what I learned. It's back to the people, back to the cultures of the firms. I've seen them. I've seen PE firms. I think certain PE firms have the reputation they do. They're full of assholes. And then there's some I'm actually learning. There's some really good PE firms out there, which I'm now hopeful for.
And there's nuances to the questions you can ask, both on reputation and what it's like to work with. You can ask for, in that pursuit of the deal that I mentioned and sharing some of that information and letting a couple of groups run hard. One of the bigger risk factors you'll have as a founder is, okay, I locked arms. They're getting ready to put a ring on it. What's the chance that they walk away from the deal? Now, some things are out of a firm's control, right? And we do all of our diligence. There are findings within the quality of earnings and background checks. And there's things that happen that are very good reasons. To your question about sussing out certain firms and potential behavior issues, you can ask for, what is the LOI, the signed LOI to close rate, which means you came to an agreement of terms. It's been negotiated. There's value. There's expectations on a whole number of terms. and you sign this relatively lengthy document that gave a firm exclusivity, which means you're not allowed to talk to anybody else. They're going to give it a full-throated effort. What's that close rate, right? And seeing that close rate and then pressure testing that with references, you may find that some firms are super eager to lock it up, right? And then drag you along, retrade on terms, and really demonstrate some of that behavior that you should probably be most concerned with.
Teach me how to negotiate a term sheet. What do you call it? Do you call it term sheet or LOI? Growth capital language. What are we doing?
Initial term sheet is the IOI, which is an indication of interest.
So then, your IOI, you'll reference the term sheet.
An IOI is just it's a outline of terms. It's a talking document. And then there's a move to a letter of intent, which often has a timeline, an ask for exclusivity, a willingness for the firm to spend money and resources. So it goes from...
And a price.
So
your IOI, do you put a price or a range on there?
Price and range, depending on the situation.
Yeah, okay.
Depending on the situation.
Kind of a pretty rough thing.
And it's a talking document, right? We expect you to roll between 60 and 80%, right? If it's a minority deal. We would endeavor to put this amount of primary capital on the balance sheet and this amount of liquidity at this value. And it's a discussion document. It's really meant to be written in pencil so that we can say, hey, look, we've had a first set of conversations. We're very interested. Here's how we're thinking about approaching a transaction. Let's have a conversation.
So this competitive process, I want to solicit these term sheets. That way I can wind it down with
my only caution to you is a very interested firm will try to blow right through that process and get to the LOI.
Okay. Let's talk to me how to negotiate these terms.
Figure out what's most important to you. And look, I've made plenty of mistakes in these discussions, this work with founders, but in the end, figuring out the 2-3 things that are most important to the other side of the table and the 2-3 things that are most important to you and solving for that 4 to 6 set of points is probably how a very good term sheet comes together.
Okay. I'll tell you what I think. You tell me where I'm wrong.
Sure.
Okay. One would be the exit timeline.
Okay.
If there's sort of, I get it, I got capital in, this is now formalizing or institutionalizing the business. You got to deliver a return to your investors. And I want to understand that, if I'm not ready for that exit, is there options to do something and continue? That's one. The second is control. Really, do we create the board? How do we create do we have dual class of shares? Do I get control of the preferred over common? That's the second. And then the third is, I would call it the gotchas. I'm thinking of the preferred X, returns and things like that, where the gotcha, like he didn't think, 3X preferred return was you didn't think anything about that till later on. You're like, damn, now I'm screwed.
Yeah.
Are those my right top 3? Would those be your top 3?
Absolutely. The gotchas for sure. The first two, I think we pull apart minority versus control deals. You sell me 80% of your business, you are giving control.
Yep.
Now, I and TCG, we approach that board and that investment as if we were minority investors, right? Giving control doesn't mean giving operational control. Back to my silly idioms comment. I want to be invited into your kitchen. It's your kitchen. And I want to be told, you focus on that part, right? You're chopping that, you're searing off that, but I have control of this whole set of the kitchen. And figuring that out in diligence lets us lean into something like M&A, lets us lean into something like capital financing or whatever the strategic objective is where we, TCG, think we can help. And then we stay out of the way for so much else. Now that's operational control, which even if we have 80%, should be 90% of your headaches, which means I really want to make a change at this VP. I really want to go tackle this. I really want to go lean into this strategy. Those operational decisions, until you really come to that strategic discussion, are all really yours. So that's one part. Now the control-minded, when you sold us 80%, and in 4 years we get a bona fide offer from a strategic or another PE firm that's compelling, we as control owners have to act on behalf of all shareholders, right, and our own LPs, and we have to do what's best for the company, right? Now, the dirty little secret is that it's unlikely without your support as an ongoing CEO that we're going to go consummate a transaction, right?
Right.
It's very, very difficult to take a management team, let alone a founder, kicking and screaming into a sale process. So control means we have the right to make the decision. Doesn't mean we can actually execute on said decision. As a minority shareholder, those protective provisions, they really only have teeth in a very few percentage of chances. You talked about controlling the exit timing. If you and I worked on a deal together and I had a 6-year redemption period, right? So at the end of 6 years, probably 5.5 years, the legalese would be that I'm able to get a fair market value set of work done on my investment. The $30 million I invested is now worth $100 million, according to some firm. You have the responsibility legally to now go transact and go deliver me $100 million of value. You could go raise debt. You could find another private equity firm. You could sell the business. There's that threat, but in reality, it's very, very rarely used because either the company's not doing well, and my 30 or 100 doesn't really matter, or it's doing swimmingly, and we're actively working on what's the best outcome for all of us, and we're going to work together on it. So that's as big of a consideration as control is, or minority protective provisions for a founder who has built his or her own business on their own bootstraps. The transaction itself and how an investor comes in, buying 80% or buying 30%, and that whole dating process should make those controls much lesser of a concern. So in summary, there are valid concerns now with the right partner and the right process. When you go to sign and you get that requisite level of liquidity and growth capital delivered, I'd want you to ask those same questions again and see if you have a different feel of it. That's the first two. The third is really just a business point, the gotchas. And having really good advice and being a very transparent investor when there are those structural items to help bridge valuation, it's a really important exercise. For instance, you think your business is worth $100 million. I think it's worth $60 million. We have a valuation gap.
Yep.
But God help me, I want to invest in your business. And you really want to partner with me. We're staring microphone to microphone, unable to get to that valuation. There's structural ways to make that happen, right? There are protective provisions that can help on the downside where I see your plan to be pretty risky and I want to be protected, right? So there's unequal economics on the way up to a transaction. There's also an ability to transact much closer to my $60 million in value, but give equity kickers and a bunch of bonuses on the way out because you think it's worth 100 on the way in. And so understanding and diagramming and being very, very clear, both with the partner and the principal that you're investing with, and then from a legalese perspective, it ends up becoming a really good mechanism to bridge valuation. When I have done it and when I have seen it in use, hasn't mattered because the companies were on such great trajectories. They blew right through said structure and ended up not being an issue. So it's of concern and should be looked at, but hopefully mitigated.
That's a lot.
That was a lot.
Yeah, no, that's some really good points in how to think through that. On June 4th, I'm excited to be speaking at the Corporate DealMakers Forum in New York City, hosted by IMN and Informa Business. I'll be joining execs from GE, Pfizer, Johnson Controls, and more to tackle the big topics: AI-powered diligence, faster execution, portfolio strategy, antitrust moves, and what's actually getting deals done in 2025. I'll be sharing real-world insights from the buyer-led M&A front lines, not just ideas, but strategies you can actually use. Register now using the link in the episode description. That's informaconnect.com/IMN-corporate-dealmakers. Come join me in New York and let's keep moving deal making forward. What would you do? What's the best path? You got some interesting scenarios of do you look at the accelerators or I think that's where the preferred returns come in to sort of de-risk the high risk.
The first bit is that when we're out networking with founders and we're getting to know what they want to go build, there's a professional plan and a business plan that they're going and chasing in a category. And so TCG meets these unbelievable founders across areas of passion and are just building unbelievable things. The challenge for you as the founder is to go figure out where those personal and professional lines are going to cross. And what I mean by that is there's an element of liquidity, back to that poker chip example, in which whether you're solving for a new residence, something for the kids from a trust perspective, but there's some element of diversification and well-being that you're going to start thinking about. Some people have a number, right? If I had X, I would stop really thinking about what I'm doing on the family side and really just able to focus on the business. And that's what we're trying to unlock as growth equity investors, is to, in the de-risking, increase risk ratably, right? And in a smart fashion, but help you make better decisions because you already have all those black poker chips in your back pocket and you're doing great personally. Now let's go take healthy risks for the business and actually go seize that opportunity. So figuring out that number and figuring out what you're trying to solve for, it sounds like you've done some of that thinking, can be a really powerful way to start. And so sometimes I'll sit with founders and say, what are you solving for? And they'll sometimes give me a raw number. Sometimes they'll say, I'm only going to engage in a minority transaction. Whatever that liquidity ends up being, I'm confident that will be enough for what I'm looking for, and start there. And then you can work backwards.
So if I was, and this kind of is going to lead to this question around wealth preservation. Some of these people out there, like the Michael Dell, blows my mind. If anybody knows Michael Dell and get him on the podcast, I got a huge reward for you. I just the whole take private, and if you look at his equity share before to post all the coming back public,
legendary.
It's I think the biggest M&A move done in history that nobody really looked at that perspective. They had all the news flash about all this, the Carl icon, all that engagement, the whole spin off VMware, but the wealth creation was blown everything out the water. And so I'm always curious on the preservation side of this, because then you hear the other stories, which is the not good. The founder that has a huge exit, big number, but then they had this tiny little check that came out of it because they were just so diluted and just the way the economics were. Like putting these terms together, how do you sort of protect yourself or build in that way? And just, I don't know, the ones that have done it well, that's a curious thing. I really want to learn. And I know you've seen it from your side. How do you sort of build that as part of your plan that you can grow your business? Because even when I look at doing acquisitions, capital intensive, you bring an equity partner in, you're going to get diluted pretty quickly. What is that path? What is that magic to do it and still preserve wealth in your sharehold?
Yeah. The first comment is that so many of the founders have been just so generous with philanthropic efforts with their own employees that seeing a number and thinking that only goes to that founder, and you have to kind of think about that risk. They're often in that position because they're so generous and they've built so much culture and are embedded within that employee base and the community. I was with one founder and walking around, and there was a community hall, and at the very top of the list, that built this whole, this very nice building and set of facilities. There were a bunch of smaller donors listed at the bottom, but at the top, it just said anonymous. And I looked at him, and he just smiled. And that gave me so much comfort that he had invested so much in that town that when more liquidity was coming, it was just going to be more of that. Now, he deserves to appreciate what he built, right? And sees things that he wanted to do in terms of if he wanted a new toy or a new home. But I also had that notion that he had already invested that much into the town via this anonymous mark, and he was just going to do more of that, right? And then I watched it as he gave a very good amount of his liquidity via deal bonuses to his employees. And so fathers and sons and grandfathers were either retiring, they were going off to college, they were paying off homes on the back of his presumed liquidity. So you can pattern match within a founder and getting to know them of what that's going to look like. At the same token, this is not a very small slice of a big exit, selling down a little bit in an IPO. This is a meaningful event because so much of the equity has been built into the company that this is the one big event. It's a mini IPO just for a founder or a set of founders. And so understanding, and in that dating process, understanding from where they came from, what is most important, where they intend on spending money, where would you want to go live? Where do you want to retire? Those things come up over the drinks and the dinners and the time that you spend with somebody. so that when you see the raw number in the funds flow and you know exactly what they're getting, you have great comfort that they're going to be using it the right way. And you have belief that they will take care of their family, they will spend it the right way, and that they have enough equity left in the business that the value that they've built so far is going to be the value that they try to ascribe and build with you. Well, that's a great journey to take on.
Let's talk through that so we can build our roadmap together. So for me, I don't know, maybe about 15 million because I pay the taxes. That'll take care of me. I can get some property taken care of and no money for kids, family, all this stuff they're all set. That's sort of a near term within the next couple of years. Longer term, private jet. And taking care of the team, both. Because I already created an option pool. Even though we don't have outside investors, we built an option pool for 20%. Every employee has some options to it, and the management team is highly incentivized around that as well. I want to see them achieve their dreams as well, and get a jet too, because the dream is to have a podcast on the jet.
There you go.
And I'm like, oh, you got to get back to the Bay Area. I got to get it back over there too.
I recently, I think it was last year, the year before, I received a little paperweight from United for achieving 2 million miles. So I still aspire to the same end goal that you have, but far too much time on planes. But the solve, which is I want to take care of my kids, pay off a house, get the place in the Poconos or wherever you'd want to go. Those are all completely reasonable against the equity value that you've built. And having those conversations and hear you talk about that, I'm perfectly fine being that mechanism, because in that multi-year process in which we've gotten to know each other, I know that's what you're building towards. I know how well you've taken care of employees. I know from where you're going to be taking this wealth and delivering it to. I had a founder who, despite all of this success, was in a rental house and said, I want to solve to put my kids into a really nice house and not have to worry about them in schooling or inheritance and just be done. And then we're going to go build something magnificent. And that's the greatest pleasure of this job, is that you can be that mechanism to let them really go recognize the value from which they've bled and sweat into a company, and then go chase something big together.
You didn't answer my question. Okay, near term, I get it. That's not too hard. But the jet, I need to really preserve value to make sure the jet happens.
And taking on a minority partner and then going and building something great and taking it from the 20 of ARR to 50. I'm not a jet guy, but it sounds like that's the right level of scale.
This podcast can be in the jet. Well, hopefully we do something in
between. Maybe you'll invite me back on that jet with that podcast.
We'll be something to do. Yeah, we'd have the studio in there. Okay, challenge me on the timing. So I got sort of, I don't know if it's like more of an ego of just created this arbitrary milestone that we got to get to 25 million ARR before we do a minority cap. Mm-hmm. And then hopefully strong growth trajectory, and I can go make an argument for getting 10x revenue valuation. Let's create a package for 75 million that puts it around that 30% mark. Challenge me.
So back to this personal professional lines, which across on video in terms of crossing, there's a presumed path. And at that level of ARR, I can find the right level of liquidity to make things work.
I would add, I think I can work with this next tier of investors that are like, more the gold standard investors.
In starting to meet and work with those investors, hearing from their experiences on the path from 10 to 25, or in my world within consumer investing, in the path from D to C, getting into wholesale meaningfully, opening your own retail units, there are big jumps in scale and organizational theory that happen for these companies to help them make it through these levels. The path from 10 to 25 is not as simple as just blocking and tackling. It'll come with organizational stress. It'll come with likely up-leveling certain levels and certain members of the team. And so I think starting to understand what's going to come in that path and how quickly it's likely going to come can influence where that line sits for you in terms of the professional side. The other bit that we haven't talked about is what happens when there are just fundamental macro things that come and throw off your very notion of what the timing should be. You're a consumer brand, or worse yet, a consumer services company that deals with stuff in real life, and you were thinking about doing something in 2019. You said, no, I really want to go push for 2 more years, right? My in-person business model is really going to hit it in 2021, and that's when I'm going to sell and really make money. And I really like these investors, but I'm going to hold on for 2 more years. You're holding on for 6 more years, right? It's ironic. We're in think it was year 5 of COVID that just happened. But there are a number of founders that we worked with that were really holding on for that 2021, 2022 timeframe, and they're still holding on, right? And so if you find the right investors, challenge yourself to say, if something fundamentally shifted in the rest of 2025, wouldn't it be good if I had this investor along with me? And maybe that affects those 2 lines, that intersection point a little bit.
And then, so you got a little bit of how they would value it now as opposed to then as well.
And it doesn't mean the conversation's over. It just means that maybe there's a valuation gap. Maybe they want to see more proof points. They've gotten to know you. You've invested some time and gotten to know them. But the right investor that sees and hears and understands what you want to do will lean into your company or asset at the right point. And hopefully that's, 3 months before a pandemic, not after.
Yeah. So let me complicate this a little more. I have we did 44% year-over-year growth last year. And despite management restructuring and all these things that disrupted the business, have strong confidence in the coming years. Of course, something surprise could happen. But because of that, that's where, we operate right at break even. So we push for the growth. We got strong cash reserves. So I don't technically need the money. That's where I got this, just wait till we're 20, 25 million. I know it gets harder. People are going to message me. After 10 million, it gets harder. Economics change. I get it, but why not? That's the fun part. Let's figure that out. But now I want to go do an acquisition.
And an acquisition could be the catalyst, right? And back to that poker chip example, if you're going to either scrape together friends and family money, you're going to take on debt, you're going to go have that founder roll equity, right, and dilute you down. And then you're going to have to go handle the acquisition itself, which is not always straightforward, both in the diligence and then the post-deal integration. Those are all challenging things. And so if you think that 10 to 25 could involve an acquisition, maybe that's the catalyst, right? And maybe you use the firms that have been reaching out to say, hey, I think M&A could be a very big stepping stone for us. We're ready for it. You 4 firms seem to have spent the most time in category. Let's just have a conversation about what you would see and have them bring you ideas. Have them, because they're out talking to many other companies just like yours. They would love nothing more than to bring some acquisition ideas and perspective and maybe something you haven't thought of. And then they're the very firm that would then help you with that work. And if they can unlock liquidity, maybe that becomes your catalyst.
Yeah, I find this deal, I lock it up and maybe do the deal based on the post-combined company valuation.
Yeah. Devil's in the details, but yeah, I mean, that's the approach, is to go do something that you couldn't or wouldn't necessarily want to do solo.
How do you weigh out all these, and we talked about the firms, the growth capital, the private equity, VCs, but we didn't mention there's family offices, good old independent sponsors out there. No offense to any independent sponsors, but you got high net worth individuals,
Yeah.
I could go ask you for a check personally, Stu, there's that. I can, you got strategics that are doing stuff right off the balance sheet. And then you got these evergreen funds, and the evergreen sounds interesting, where it's like, oh, we don't have to get pushed for, an exit timeline here. So how do you sort of?
Yeah, absolutely. So there's one of the idioms is value add capital, right? And we want to bring the resources of our firm. So I can honestly say within TCG, the operating partners that we have, I was just with one at lunch, our talent partner in Margot, the Rolodex of folks, the authentic Rolodex that we have, because I'm the black wolf that, or the black sheep that actually wasn't a full-time operator. We're all operators, now turned investors. So the Rolodex and the perspectives that we have can fundamentally help you, which is different than an evergreen fund, a family office that's just deploying capital. Those are sources of capital, and they can be very effective for you if that's what you're solving for. Usually a founder, when they're ready and willing to take on growth equity, they want the resources as much or almost more than the capital, because they probably have dividends. They're probably taking home a healthy salary. Liquidity is nice, but it's this moving target, to your point. It's the resources that can really buttress growth and help you augment that opportunity. And so when you can tap into a network of like-minded executives and portfolio companies and shared experiences, that this is what we do and this is where we invest so much of our time and our investors' money to go create goodness, that becomes such a helpful function for you as a founder.
It goes back to that the network piece, how that company's going to approach value add, getting that real good sense. This is a partner that's going to allow you to run twice as fast, twice as far.
Yeah, it absolutely is. It's
that was what goes back. That kind of oversees everything before you get into details of like capital source structure and stuff like that.
Absolutely, because the very definition of us being invited into a business is that we're not just capital. And if we were just capital,
that's the big picture.
You could find a different source for it. You could find bank financing.
I agree.
Right. That's a perfectly good way to do it until you want the resources and the network and the learned experiences, both good and bad, that we've had as investors to go support you.
That's you're right. That's what it comes down to, is a big picture, seeing how that's going to amplify everything, the relationships and so forth. And then we'll keep it a little competitive, but that sort of terms is more of like the 10-20% difference.
And really, on a minority deal, if you're selling the business, there's the for sale sign, and it's an auction. By definition, it's an auction. A minority deal, you're selling 30% of the company, whether you value your company at X or 105% of X, right? 100 million or 105 million. The right partner is way more important than the relative value. Not to say you should always take the lower bid, just the relative delta and economics in the end shouldn't really matter against the ability of that partner to add value and truly be your partner in crime. That's of way more importance.
I have not been good at getting the most value out of advisors. And when I think about getting an investor in the company, I want to make sure that doesn't happen. So can you teach me how to get the most value out of it? Because I feel like, we had good conversations, we get along like this, but then things sort of drift. What have you seen, the founders that are like the best of getting the most out of you and solving the business challenges? And, I talked to other founders that feel like they're micromanaged by the board. How do I sort of get the best out of the relationship with a good investor?
Absolutely. I mentioned the notion of board conversations and then one-off conversations. And I love nothing more than when a founder says, I just catching you up, I've had these 3 conversations with such and such advisor, right? Or you'd introduced me to this person. I've already had 4 or 5 conversations, one just to get you back up to speed. That's terrific. That means that there was a critical path and a well-connected set of relationships that led to those conversations. So that's one part, just making sure that any advisor has that one-on-one relationship with you and absolutely has the right and the need for you to call them or them to call you as they're thinking about things, independent of the board. The other part is setting expectations and leaning on your investor to set those expectations very clearly with the advisor. So often, investment firms, growth equity and private equity, find category or industry luminaries, put them on the site, tell them that they're operating advisors, introduce them to you early in the process, say, you should really call Jack or Jackie, right? And that may be the one and only call. Finding an advisor that has either specific economics in your company, equity typically, or has an operating executive role in which they are dedicated to a certain number of companies within the portfolio ensures just that much more focus. To you as a founder, I'd kind of beg for forgiveness. Call them as frequently, right, as much as you want, and have that advisor push back on the firm and say, hey, you gave me X amount of equity in the company. I have this arrangement with you as an operating partner within your firm against these sort of time expectations. But we are really leaning into this company, right? And this founder is calling me and I'm loving the help, but we're pushing, meaningful hours in a month, more than I expected. I'd rather that conversation that you're finding great value from that advisor and I have to go up his or her equity or figure out a different way of compensation because you're finding such great, lean on them, right? Make it my issue that you're spending 10 hours or 15 hours or 20 hours a month with this advisor and you're hitting it off and solving real problems. It's leverage for me and it's a better person for that role. I can go figure out the economics on the back end.
I invest the time to squeeze the lemon with you, get the most out of it.
Absolutely. And then on the inverse, you're calling an advisor or calling an operating executive and it's not working. It's not in my vested interest to have somebody on my firm's behalf that's not delivering value to you or the company, let it be known. That's no different than another executive that's not working out. We'll figure out a different path for that person.
You're going to change the board seat?
Totally. Absolutely.
What does break down the relationship where we get pissed off at each other?
It's rarely happened. I've been quite fortunate. It's been...
You can tell me the stories from other people.
Yeah, absolutely. There are sometimes challenges with selling control, and then especially when the presumed path is for a CEO transition to happen. And that can come from a couple of different ways. Sometimes a founder will say, if I'm selling 70 or 80%, I'm ceding control, I have less economics and equity in the business. Yes, a CEO transition, I want to not only recognize my success, but empower the next generation of leader. Bringing on a CEO to take over a founder-led business is tough, right? I've found more success with COOs, right? And I remember meeting with a founder, and I could barely see the person because there were so many stacks of papers, which each represented a direct report. My comment was, I think we need a COO in here, right? To just help divvy the responsibilities and help you kind of see above the clouds, not be in the clouds. That COO can then much more easily turn into a CEO over time. That's one friction point, but that's really not on the founder. It's more on the stage of investment, because we're investing in these founder-owned bootstrap companies that have just, I mentioned that glacial process. They've been through hell and back to build this amazing company. And yes, they sold control, but there may be a little bit of a cognitive dissonance with the fact that, well, now someone else is going to run it. And so that process and the emotions that go with it are totally authentic and totally understandable. But that, to me, is the only real consistent friction point, is trying to help a next generation leadership. We don't come in with a presumption of bringing in a CEO, right? Because we're backing founder-owned companies. But
they don't see it that way. And I've seen that. That was actually a big thing that came up when I brought our COO in. A lot of concerns about the founder letting go of operational responsibility. And
you don't come in with a presumption. And even if the founder expects it to be coming, it can be emotional because they're having to let go of their baby within a 5-7 year time frame of this new first investor's investment horizon. And 3 years in, their trusted number twos are all reporting now to a new CEO. They are now still at the board table, but perhaps interacting with the board in a different way, right? Not leading those meetings. There's a lot of emotions that go with it. And those are understandable, right? Because these are not private equity owned businesses in which the CEO is the fifth CEO that's been running this 35-year-old platform, right? And they're just coming in with his or her own network of executives. This is a founder that was founder CEO that's now just founder. And so that happens. I have plenty of CEOs that are still the founders, and that's great. There are ones that have transitioned because they wanted to, and that's great. And it's a natural part of the stage in which we invest, that those emotions are perfectly fine and frankly healthy for the relationship.
Do you see a big difference between bootstrapped and venture backed?
100%.
What's that like?
100%. So bootstrap companies, by definition, have watched competition come and go and have clawed and scratched their way to that level of success. And they've been through their own scaling issues over time. The culture and the sort of ferocity of which the founders have built that business, you're stepping into just a prideful organization, and it should be, right? And it's achieved that level of scale and profitability through that glacial process I mentioned. Venture-backed companies are seizing an opportunity which by definition is massive. It's evolving very quickly, and it's highly, highly competitive with other very well-funded competitors. It's a race, right? It's the flag planting in the Wild West, right? And so there's an attitude of move very quickly and break things and go seize opportunity, and that the winner based on time will seize so much of the rewards. Not always the case. I think Facebook was the 56th social network or some remark to that degree. But so oftentimes it's the opportunities in front of us, and we have to go spend against it and use capital as one of the tools to go get it. A bootstrap business uses the fundamental value prop and the winning over time and the people that sit behind it to then go deliver that success.
That's like a well put point in terms of the difference. I never even thought about it that way, but that pretty much says it all. I wanted to just maybe put all this stuff together and kind of highlight one of the investments. And one of the ones that I noted that you have been a part of 2 times, I guess, at Norwest and at the current firm is Vuori. I say Vuori as I'm sitting across from you wearing a Vuori shirt and I'm wearing Vuori pants, and I believe I'm wearing some Vuori socks too. But I love to hear the story about what that journey was like, and it kind of opens up too, since I know you're more focused on consumer brands, which I'm not. So I'd love to hear a little bit about kind of what makes it unique investing in those consumer brands, because I feel like there's a lot of them everywhere. How do you sort of put the dynamics together of creating the winners or identifying them?
Yeah, absolutely. It's a fascinating story. Super privileged to be able to back Joe and his team twice, and it's a fun story to tell. Joe is an N of one. He is an absolute just mensch of a founder. He's a really, really good person that happens to have built a massive and very, very successful brand. And so it's been a pleasure of backing him twice. Met Joe at Outdoor Retailer, which is it's a conference, and we met in his booth, and it was a 15 by 10 foot booth or so. And at that point, he had half dozen retail units, a burgeoning men's brand. It was born out of Encinitas. It was an Encinitas brand, and I fell in love with him. I could not stop thinking about what that brand could become.
What was the brand called?
It was called Vuori at the time.
Oh, it's called Vuori. Okay.
Yeah, and it was early on, and it was doing quite well. He was building it profitably. It was growing well. It embraced the Southern California lifestyle, which was how I met 90% men. How at that time can you help put people in unbelievable product that works at the beach, the cafe, and the gym all in the same day? Because it's that Encinitas lifestyle.
Yep.
And to my point earlier about backing founders, and in the investment thesis, it being founders and team, and then everything else, our belief was utmost in Joe and what he could deliver along with his team. He had such a belief that product wins within apparel, and that his focus was not only people, but product. And so his investment and belief in product, we knew that the transition from men's focused to adding women's was going to be very much on the back of really, really high quality product. We didn't know what that winning silhouette or category would be, but that he absolutely had a right to win women's. And so we did some work thinking, what happens when women's takes off? What happens when a Southern California brand expands meaningfully out of California? We'd had the benefit of investing in Kendra Scott, which expanded from Texas on out. And so we had a little bit of that concentric circle exercise. And if they achieved both genders, and if they achieved outside of California, we saw nothing but runway. Was doing great, was doubling, was a very, very fast growing brand and doing so profitably. And he's a CPA by training, and so has an even more healthy respect for P&L because he can build them himself. And then COVID happened, and they seized on COVID in such a way that between product, content, they had a whole online fitness community, and then a delayed retail expansion in which they really seized on the opportunity because so many others were so nervous about retail that when we came out, we were growing obviously very, very quickly. It came out as an absolute American brand, and it continues to grow unbelievably well. Utmost respect for him and what he's built. They have nothing but opportunity in front of them. It's just a really, really, really good company.
Give me like the boardroom view. Like, how did you interact with him? And I'm always curious with these kind of products, because I feel like trying to bootstrap something like that, it'd be just so hard to figure out how do you scale nationally. And I liked how you had that point thesis of, can you go from being local to the regional brand, and that sort of builds you the runway to go everywhere.
Yeah, absolutely. So we joined as a minority partner, and at TCG we took a minority stake as well. And
you
so
do what I want to do. I took the commercial recap.
Absolutely. It was a competitive round, and it should have been. And as a minority partner, it doubles down on that kitchen example of where you're doing something well, we're joining you, and we really just want to focus on a certain few areas. Product, we're not going to be helpful with product, right? I look much better dressed now, right, by wearing said product, but I don't have a firm view of silhouettes or how things should look. And so stay out of the way of that, right? Making sure you have the right resources for retail to make sure it's a thoughtful expansion with really good returns so that that flywheel can run well. At the time of our investment way back when, he had no CFO. He was his own CFO. And so we leaned into some really helpful support to say, build that layer of infrastructure to make 2021 and 2022 that much easier. Having a CFO as COVID hit was perfect for him, right? He was able to focus on such different and bigger problems because Des, who is still the CFO, was absolutely terrific and was a perfect right-hand person for him. So figuring out where you can help and where to stay out of the way is often one of the more important attributes, especially with a brand or any platform that is growing that quickly. It's a do no harm type of a DNA.
And it goes back to supporting them with more of those introductions and
absolutely, and being supportive on the edges and making sure that nothing inhibits his growth because the company was doing just so well.
I'm curious about that too, because the brand came out really well and it's a highly competitive clothing in general. I mean, is there some fundamentals for founders operating those kind of competitive environments that you sort of noted?
Yeah, absolutely. So to my point, Joe is focused on product, and rightly so. And the brand has run on product-led growth, right? Because people talk about it. People just are effusive with how good it is, how nice it feels, how effective it is, how long-lasting it is, how good it looks. I mean, all the attributes of a really, really good apparel brand. More broadly speaking, when you dive into a consumer brand, you can get trapped with easy to talk about, but relatively shallow, in my point of view, metrics. In the same way that people talk software rule of 40, that tells a story, but not the whole story, right? LTV to CAC is just one of the very measures of a company's success. How you define LTV and what you put into CAC, which is it's a numerator denominator and a ratio, can have wild impacts, right, as to what the health of your business actually is, especially when you start adding retail, wholesale dynamics where there's other channels to go get your product and go find the brand. It makes all those numbers really, really messy. So seeing the forest and seeing the trees when you're valuing something in terms of repeat rate, unaided brand awareness, aided brand awareness, return rates within different categories of apparel and accessories, and then reviews all point to how much a brand is beloved and how naturally it will spread. At TCG, we love brands and experiences and consumer platforms that when you sit around a dining room table for a Sunday dinner, you can't stop talking about that product or service. So there's plenty of great consumer investments that no one really talks about. They just move and they work fine. But when you sit and you are a surfer and you're talking about Surfline, or you have really improved your health because you track everything with your Oura ring and you pass around said ring. You have gotten into gardening and now you're talking about Epic Gardening and how much it's educated you. Those brands cause a natural NPS where you just want to talk about things and you really want to share. And the number of people that talk about Viore, independent of influencers or performance marketing or anything else, that just sit around and just say like, that's a really good looking pair of whatever. That's the best form of marketing, right? Because it's authentic, it leads to a quick conversion, it's free, and it's a really good way to build a brand.
I like that you put the whole spectrum together of looking at some clear metrics, like the CAC is really important, but then you get to more the soft of like how much these customers really love the product. It's interesting how you put that together for your diligence. What about the market outlook? Like in terms of you do all this research, do you sort of see that when you kind of hear Joe's story about like building something for Beach Cafe Gym? You know, how do you sort of put that against like, oh, you know, what's our market outlook for that as a category, or do you not? You just look at what you just described.
Absolutely, it's reflecting back on that. We're at the 5-year mark of COVID. think about what we've been through in just 5 years. And so if you were trying to make an investment in the fall of 19, depending on when you were in the fall, you couldn't have predicted COVID, right? No. And the boom and the bust, especially within consumer, that happened from that in terms of pulling forward demand and cheap money, and then the slough that came off of that. We emerged from that. We're now in a tariffed environment, right, which is causing all sorts of supply chain disruptions for brands. And now we're heading into a point of more economic uncertainty. That's a lot within 5 years. And so when you take an investment perspective, of course, the short term needs to be acknowledged to make sure your company gets off to the right foot. But for a growth equity investor, you're likely investing for 10 to 15 years. And what I mean by that is you're investing for the likely 5 years that you hold something. But as you sell something to another sponsor or to a strategic, they're going to be looking for not only their 5 years, but likely the next 5 years, right? And so if there's an end cap because it's a fad, right, where there'll naturally be a drawdown, there's an end cap in terms of the number of retail doors, the number of retail units that you can go find. If there's an end point to any of those, within the next 10 to 15 years, someone will find it and it will compress multiple and compress value. And so it's not that you can ignore what's coming in the next year or two, but you have to find enduring products and brands and founders that will navigate whatever happens and succeed, because no one knows what's going to happen in the next 10, 15 years.
So you don't have this big calculation of TAM and this and that.
You want to make sure that the market's big enough.
And
that the tailwinds are there so that you're not completely sailing into the wind for the first 3, 4, 5 years. You want to be on the right side of history, another idiom. So, acknowledging where health and wellness trends are going, where general apparel trends are going. Those are all obvious areas of focus, but no one could have predicted that post-COVID, I would sit here in New York without a sports coat. But now it's perfectly fine, or at least I think it's perfectly fine, because we've brought down the level of what can be what Viore calls commuter wear, but is just perfectly good fitting, well looking stuff. But it's a new norm, and no one could have predicted that.
Absolutely. I got the knitted sweater,
there you go.
blazer on. So I really appreciate that's all awesome to just hear that as an example, and one that people are familiar with.
Absolutely.
I'm lucky though. I got in early. One of the startups I was mentoring out of, I think it was Chicago, and they were building a startup of helping you pair with brands based on what social causes, things you believed in, being green, recycling, whatever. And they paired me with Viore.
Yeah.
It was really early. I'm so happy because the stuff has gone up in price.
Yeah, absolutely. And hopefully it lasted. So you got in early and maintained.
Yeah, I got tons of stuff. I just started drawing them. This is just great. It's just easy. It kind of fits in, and it's great how they've matured it too with stuff that you can wear to the office.
Yep.
Stu, I got to ask, what's the craziest thing you've seen in M&A?
After 15 years, you've seen a lot.
Yeah.
And maybe I split this. I'll split it to the transactions themselves, and then the founders, and with that sort of a seller, right, that you're going to chase. So, I have been on the founder side. I have been part of prayer circles at lunch, unexpected. I'm a big guy. I've been physically intimidated at a company event. That was something. I have. I've chased a founder to a rooftop of a Vegas party at a conference in order to get time at 2 a.m. Actually led to an investment opportunity. So you end up in some interesting situations, right? Working, not every meeting with a founder is in an office face to face. It's you're out and experiencing quite a bit. On the transaction side, I've been CC'd on emails that I shouldn't have been, and kind of peeked under the hood and been asked to delete said emails relatively quickly. That's happened. So you see some bad behavior in that regard. I think the most formative and I consider crazy experience is, I was working at Spectrum with a just terrific now MD, Ben Spiro, on the Ancestry transaction. It was my first real transaction. Sorry, Ben, I didn't really know what I was doing, and I was, working nights and weekends trying to figure it all out. And I remember sitting, unfortunately, with my feet up. I was so tired, on his desk, and there was a capital group that had committed to the financing to help us with the acquisition. And on a Wednesday, Thursday, they were in for $40 million. At Friday, I remember talking to him again with my feet up, and they were in for like 20 or 30 million. And by Monday, the group had been disbanded and they were gone. And the GFC had swallowed them up. And I was witnessing my little segment of history, but a really well-known financing group had gone out of business and taken our 40 million to zero of a commitment within 3 days. And it's those sort of like formative periods where I knew that he, right, as a very strong partner, was going to have to go navigate through this GFC, and we were kind of seeing it in real time. I was just an associate. I was just helping and working, and I didn't realize until COVID that was going to be my time to go navigate some really tough challenges that kind of kept getting thrown at us. That one just sticks out because it was one of my first memories from M&A, and it was I didn't appreciate the gravity of it at the time, but it was meanuful. It really was
crazy. What's GFC?
Oh, the Great Financial Crisis.
Ah, okay.
Yeah, sorry. It was, it was a big moment.
That's crazy.
Yeah.
Stu, this has been an awesome conversation. I had a lot of fun. I got my money's worth. I feel so much more.
I appreciate you having me.
Working with all these investors that reach out. It's been extremely helpful. Those of you still listening, fellow M&A scientists, you got this far. I appreciate you. I would love to hear what you think about this interview. It's not a pure typical M&A focus. We sort of hit more of an investment perspective. Reach out to me on LinkedIn, share your thoughts, give me some topic ideas and criticism. I'll take it. So I'll learn to get better. Till next time, here's to the deal.